Everyone is worried that the tech industry will crash the economy, but I think it's the real estate lending industry that will bring us to double-digit unemployment with reduced consumer spending and more competition for entry-level jobs.
Let's get back to work.
Get back to work.
America is back to work.
Hi, my name is April. I'm a recruiter, usually doing tech recruitment, but I did dabble in real estate during COVID, and I have a feeling that things are about to change on the employment market. So let's talk about what happened during COVID. Quarantine came in March 2020, and between March and April, home sales crashed nationally, and some places like New York saw a 58% decrease in sales. Detroit saw a 74% decrease in sales. And during this time, some houses went up $0 in value because not a lot of people were buying. And that makes sense. There was uncertainty at what would happen next. But shortly after quarantine, a lot of people found themselves working remotely or stuck at home. By August 2020, the real estate industry was booming, reversing an 8-year decline in family mortgage loan rates, going from 1.77% growth in Q4 of 2019 to 2.54% growth in Q 2020. Why did home sales increase so much during this time? Well, people who were only able to afford rent in the big city were able to move out of the city and buy an entire home. There is a segment of people who were put on remote after COVID and then became permanently remote. I do have to say that's a small amount. It was mostly impacted by the low interest rate. Remote existed long before COVID, but the biggest impact was low interest rates going from 2020 to 2021. And of course, the Airbnb trend boomed, and a ton of people went and got several short-term rental houses that were easily rented by these remote workers taking some time away from home. And a lot of people have jumped on this bandwagon. I gotta say, once you see people on TikTok giving you real estate advice or financial planning advice, know that you are probably not early on the curve. You are not ahead of the trend. You are joining a bandwagon. When it comes to the real estate lending industry, this was a completely different environment than any housing boom before. Why? Well, previously it was banks that handled most mortgages, so that if your mortgage fell through, there was an entire banking system behind it to keep the business going. But in 2020 up until now, most of the mortgages in the US are processed by mortgage companies. And boy, do I know a lot about mortgage hiring. Right after COVID happened and we went into quarantine, I had most of my clients say they were not hiring or freezing hiring, with one that I was still able to hire during quarantine. But as recruiters, we're always looking out for the money, and my company at the time made millions of dollars placing real estate lending employees. Some of the job titles include underwriters, loan officers, brand managers, escrow officers, closers, brokers, and loan processors. Other job titles could be in the mix, but wanted to give you an idea. In 2020, it sometimes took only 24 hours to get someone hired on the job. I was seeing people get hired without any interviews, and what looked like 30 to 40 people getting hired from a third-party recruiter. So to remind you, a company that is using a third-party recruiter is paying a fee every single time they hire someone. That can be from $5,000 to $30,000, sometimes $40,000 for these underwriter roles. And that money doesn't come from anywhere. $10,000 doesn't just show up. It was coming from the huge increase of interest of home buyers, along with an increase of people who were reapplying for mortgages due to changes in rates and their own financial status. I really can't explain how insane it was during this time from mid to late 2020. It was like throwing popcorn in the air with placing these people, and those that were busiest in my company had delegated most of their tasks to other recruiters simply because it was so busy. We did have exclusive contracts with banks, but most of the companies that we worked with were individual mortgage companies. That is all that they did was mortgages, and a lot of them were brand new, taking advantage of the industry. But one thing I did hear that I will never forget, I had cold called, I believe it was an underwriter, asking her, do you want to join the real estate industry again? I see on your resume that you were active around 2006 and 7. Well, she coldly told me that the real estate lending industry is too unpredictable and she will not risk her new career just to get some quick money in real estate lending. Of course, as a recruiter, I'm more focused on filling the job than what she actually said, so I sort it in my memory. But now that it's 2022 and I'm seeing some tech layoffs, I remember that thing she said. And it seems like things are changing for people in these job titles. To give you a reference, I would work with people who had 20 to 40 loan applications on their desk any single day. Now, these people are seeing 1 to 5. So that's a huge decrease. I am not a real estate guru, but I certainly do pay attention to real estate like anyone my age, and it seems like things are changing in the real estate industry. How do I know? Well, I'm a recruiter and I can see who is applying for jobs online, and I see a ton of people in the real estate industry looking for jobs, from product manager to loan processor to marketing manager. It is super obvious to anyone that knows where to look that a ton of people that work in real estate are looking for a new job. And it seems very likely a lot of these new mortgage companies that took advantage of the increase in business between 2020 to 2021 will not have enough business. Obviously, they are laying people off. If you're subscribed to my channel and you saw the videos about May and June, halfway through June layoff videos, you know that thousands of people are being laid off in tech, but yet our president is still bragging about low unemployment numbers. And he's right, the numbers are pretty low right now from what we can see.
The jobs over the last 3 months have averaged about 400,000 jobs per month. That's historically robust and a sign we're beginning to shift to steady growth after rapidly recovering 600,000 jobs per month over the prior 6 months.
But I think things are going to drastically change in the next coming weeks. Either new numbers will come out or people will just pay attention more. But it's pretty obvious these independent mortgage companies are about to lay off 80 to 90% of their staff. And it is likely that a lot of these companies will go out of business. What happens when mortgage companies go out of business? Well, it seems to mess up the housing market, and these people have to sell mortgages to someone else. So if you are someone who's on the job search, maybe you got laid off, or maybe you just want to make more money on the job, something you should keep in mind that unemployment next year, January 2023, we will be comfortable with seeing a 2-digit number. So go into the job search with direction. If you need some more tips about the job search, I have a playlist called Professional Job Seeker that gives you some ways to increase your salary and stand out when you apply to jobs. If you are interested in the tech industry and the changing economy coming for people who want to make money, please subscribe to my channel. I'm trying to switch things up more and talk about new trending news, things that I care about, and I think my subscribers will too. Thanks for watching this video, and I hope to see you in the next one.